Hello, I'm Sam Balzana with Shalom Insurance Advisors. And today I wanted to talk about risk. One of the biggest mistakes people make in retirement planning is thinking that risk only matters when the market drops. But the truth is, risk changes depending on where you are in life, especially before retirement versus after retirement. Pre-retirement, most people are focused on their accumulation. They're working, earning income, and contributing to retirement accounts. And they're trying to grow their assets over time. But during this phase, the market volatility is usually less dangerous because they still have time on their side. And if the market drops, well, at age 40 or 50, there's still years, maybe even sometimes decades to recover. Now, that doesn't mean that risk should be ignored. It means that risk should be understood. Before retirement, the biggest risks are often things like not having a proper plan, undersaving, or emotional investing, poor diversification, not implementing good tax strategies, not having a long-term strategy. Many people take either too much risk chasing returns, or then some others take not enough risk to keep up with inflation. But once retirement begins, this conversation changes dramatically. Post-retirement, you're no longer just building assets, you're depending on them. And that creates an entirely different type of risk analysis. Now, we have to look at sequence of returns, risk, meaning if market declines early in retirement while income's being withdrawn, well, it can permanently damage your portfolio. Two retirees that earn the same exact average rate of return over 20 years can still wind up completely different outcomes depending on when those losses occurred. So now we have to take into consideration today longevity risk, the risk of outliving your money. People are living longer than ever before, and retirement may last 25 to 35 years. That means income planning becomes just as important as investment growth. We have inflation risk, we have healthcare risk, we have long-term care exposure, certainly the possibility of rising taxes, and then the idea of basically legacy concerns. So retirement is no longer just about what rate of return can I get. It becomes, how do I create dependable income, preserve dignity, reduce unnecessary risk, and still maintain peace of mind? So that's why proper retirement planning should never be one size fits all. A healthy risk analysis looks at the entire picture. It looks at income needs. It looks at your risk tolerance. Where do you have peace of mind? It looks at the time frame, the time horizon, the tax exposure, exactly where it is that your tax bracket is, the market exposure, also taking into consideration healthcare planning and legacy goals, as well as your own personal values. So that goal is not eliminating all risk, because that becomes impossible. The goal is identifying which risks matter most at each stage of life and building a strategy around them. Before retirement, growth can carry more weight. After retirement, protection and income, they become far more important. At most, successful retirement plans usually create the balance between the two. At the end of the day, the people don't retire successfully because they chase the highest return. They retire successfully because they understood the risks ahead of them and plan wisely for each season of their life. I'd like for you to go to my website, shalominsuranceadvisors.com. And inside of that, in the risk and protection tab, there's an opportunity to do a risk analysis. It's completely free. And then another opportunity to schedule a conversation with one of our advisors or myself personally, and to be able to go over that and any other concern that you may have with your retirement plan. Again, free of charge, and we'd be more than honored to have that conversation with you. So go to our website, shalominsuranceadvisors.com. Thanks so much. Look forward to speaking with you. Have a great rest of your day. Bye now.